All right. Hey, everyone, get ready because today we're going deep on this thing called the index effect.
Oh, yeah, the index effect.
It sounds kind of, technical, but
Yeah.
really it's about how stock prices
Mhm.
can go haywire when a company gets added to or kicked off
Right.
a major index like the S&P 500. Like, you'd think the price should just reflect the company's
Yeah,
value.
like, exactly.
Right.
You would
Yeah.
think so.
But it turns out these indices
Yeah.
have
Yeah, they can.
a strange power over the market. So we're using this article by Mr. Schmidt. He's over at the Eighth Wonder Capital Substack.
Oh, yeah, I've seen that.
Yeah, really interesting stuff. He's breaking down some recent research that's challenging some of the traditional views on
Right.
this whole index effect thing.
Yeah, it's interesting how
Yeah.
often the market kind of like throws us these curveballs, what seems logical on the surface,
Mhm.
sometimes has these like deeper forces going on underneath.
Exactly.
Yeah.
So let's start with like a little index effect 101.
Yeah.
Okay, so what's the traditional like textbook understanding
Right.
of how this whole thing works?
So the traditional view, it's pretty straightforward. A stock gets added to a major index like the S&P 500.
Uh-huh.
Its price jumps up. It's like a, instant popularity boost.
Okay.
But if it gets removed,
Yeah.
price takes a hit, a dip.
Oh, wow.
And a lot of this has to do with how index funds operate.
Okay. So is it kind of like this big game of musical chairs
Yeah.
with these index funds? Like they're scrambling to buy or sell based on what's in or out of the index?
Yeah.
Got it.
Imagine these index funds, they're designed to mirror specific indices. So when a stock gets added,
Yeah.
they have to go out and buy a bunch of shares to match that index's makeup. So suddenly you have this like huge influx of buying pressure. Price goes up.
Makes sense.
Reverse happens when a stock is removed.
Okay, so that makes sense. So like you said, kind of straightforward.
Right.
But now Mr. Schmidt, in his article,
Right.
he's highlighting some research
Yeah.
that throws a bit of a wrench into this.
Right. Yeah.
He talks about
Yes. Yes, he
this whole thing with the S&P 400 and 600. Can you explain that a little
Yeah,
bit?
so traditionally you'd think moving up to a better index, like going from the S&P 600 to
Right.
the 400, that'd be a good thing.
Right.
Stock price goes up, moving down is bad, right?
Well, that's
At least that's what we thought.
Yeah.
But there's this research from IHS Markit
Yeah.
that found that when a company gets demoted,
Yeah.
sent down, from the S&P 400 to the 600,
Uh,
the stock price actually jumped up.
Yeah.
On average, it was a jump of 6.2%.
wait, so getting like kicked down to the
Yeah.
minor leagues is a good thing.
Yeah, it's kind of wild.
How does that even work?
Right. It's fascinating. Imagine a company, right? It's on the smaller end of the S&P 400.
Uh-huh.
It gets demoted, bumped down to the 600.
Right.
Now the 600, it's full of, guess what, smaller companies.
Go.
So suddenly
Yeah.
this company,
Uh-huh.
it's not just another face in the crowd anymore.
Right?
It's a relatively big fish in a little pond.
So it stands out more, it gets more attention from investors
Exactly.
who are looking specifically at the S&P 600.
Exactly. And don't forget those index funds.
Yeah.
The ones that are tracking the 600, they end up with a bigger stake in these demoted companies. So even though it looks like a demotion,
Yeah.
it can actually trigger more buying.
That is a crazy twist. So it really shows you
Yeah.
that even in a market that's supposedly efficient, like things aren't always as they seem.
Exactly.
And Mr. Schmidt, he also mentions
Yeah.
that this traditional index effect, it might be
Uh-huh.
kind of losing
It needs to be.
its punch a little bit, right?
Yeah. Yeah, so the research from IHS Markit,
Yeah.
it found that most of the price action, it's happening on the announcement date,
Okay.
not the actual day the stock gets included or excluded from the index.
So the market's like getting wise to this whole thing.
It seems like it. Yeah.
Everyone's already jumping on board or jumping off
Right. Yeah.
the second the news drops.
They're anticipating what these index funds are going to do.
That's so interesting.
Yeah.
So the element of surprise is
Yeah, it's like, it's kind of gone.
less and less of a factor.
Okay. And then that brings up a whole other fascinating aspect of this, right? Because we've talked about these index funds. They're playing a huge role in this whole thing.
Huge role, yeah.
But what happens as more and more people are putting their money into these passive investments,
at
these
it.
index funds,
Could that actually make the index effect even stronger?
that's a great question.
Yeah.
And one we should definitely dig into.
Okay.
Yeah.
But before we get ahead of ourselves, let's zoom in on one more detail that Mr. Schmidt brought up, which is just the sheer
Yeah.
volume of trading that happens around these
Oh my gosh.
index changes.
It gets crazy.
Right.
Like the research found that trading volume on the announcement day can go up 200 to 500%.
What?
Yeah, it's huge. And even on the actual inclusion or exclusion day, it's still like 150 to 250% above average.
It's like everyone's trying to get their piece of the action.
Yeah, exactly.
Right at that moment.
They're feeding frenzy.
It's crazy. So even if the price effects are getting a little, more nuanced, like we talked about, these index changes, they're still clearly a big deal for the market as a whole.
Yeah. It's a reminder that even with all the algorithms, all the instant information we have today, human behavior, the psychology of the market,
it all plays.
It still plays a huge role.
Yeah.
Yeah.
So speaking of the human element, I'm curious.
Yeah.
How does all this play out in different parts of the world? Do those FTSE indices or the ones, in Germany or Japan?
Yeah.
Do they behave
It's a good question.
similarly?
It's very likely, yeah.
Okay.
Because the mechanics of index funds, that's pretty universal.
Right.
But, there's one factor that I think could really change the intensity of the effect, which is the size of the funds, their assets under management.
Oh, okay. So a massive index fund rebalancing its portfolio.
Exactly.
That's going to create bigger ripples.
Way bigger.
The small one, yeah.
Exactly. So it's it leads to this question of as passive investing keeps growing,
right,
could we actually see an even stronger index effect in the future?
That's a great question.
Yeah.
And that is exactly what we are going to be exploring next.
Awesome. Looking forward to it.
So stick with us as we delve deeper into this evolving world of the index effect and what it means for investors like you.
It's going to be good.
All right, so we've talked about how this index effect thing, it's a little more complicated than it looks at first glance.
Right, definitely more nuanced.
But for investors, people who are actually, putting money into the market, how does all this, how does this translate into action? Can you actually use this knowledge to your advantage?
So it's tempting to think, right, I could just, buy a stock right before it gets added to the S&P 500, ride that price bump,
Easy money.
Easy money, yeah.
But I'm guessing it's not quite that simple.
Not quite, no. Remember we were talking about how most of that price action, it's happening on the announcement date?
Right.
Not the actual inclusion date.
Right.
So by the time the news is out there, everybody knows a lot of that potential gain, it might already be gone.
So you'd have to have some serious inside information.
Yeah, pretty much.
To really beat the market.
And even then, it's not a guaranteed win.
Right.
We're talking about averages here.
Right.
So not every stock that gets added to an index, it's going to shoot up in price.
Sure.
Some, might barely budge. Some might, take off like a rocket.
Right.
There's always risk.
So it's more like, informed speculation.
Yeah, I think that's a good way to put it.
Sure thing.
And then you have to factor in, things like trading costs.
Oh, right, of course.
And just, the general market volatility.
Yeah.
Which can, affect the stock price, regardless of its index status.
So it sounds like, knowing about this index effect, it's more about having a deeper understanding of how the market works than finding some secret loophole.
Exactly. It's about, seeing beyond the headlines, understanding what's really driving those price movements.
And that knowledge, that can be valuable even if you're not actively trading, right?
Absolutely. Yeah.
So it's kind of like having, an extra layer of insight that helps you make smarter decisions about your investments.
Right.
Whether you're, in it for the long haul or playing the short game.
Exactly. Yeah. And remember, it's not just about gains.
All right.
Understanding this, it can help you avoid losses too.
Oh, okay. How so?
If you own a stock
right.
and you find out it's about to be removed from an index, well, knowing that it might take a price hit can help you decide, do I hold on or do I sell?
It's like having a heads up that a storm's coming.
Exactly.
You can either, batten down the hatches or get out of the way.
Yeah, get out of Dodge.
Okay, so we talked about this earlier.
Yeah.
What about the whole passive investing angle?
Right.
With index funds becoming so popular, could that make the index effect?
It's a great question.
Even more intense.
I think so. You got to think about it. As more and more money flows into these index funds, right, they're rebalancing actions, buying and selling based on these index changes. It becomes more impactful.
So it's like kind of a snowball effect.
Exactly.
Right. The bigger they get, the more they influence the market.
Yeah, the bigger the ripple.
And that could create even bigger price swings.
Exactly, yeah. It's definitely something to watch, especially as, the line between active and passive investing.
Well, what do you mean by that? Like blurring the lines?
Yeah. Well, think about it. With passive investing, the index funds are trying to match the index as close as possible.
Right.
Some of them, they'll buy all the stocks in the index, proportionally. That's called full replication.
Okay.
Others, they use a technique called sampling, where they just buy a subset of the index's stocks.
Oh, interesting.
Which can be, more cost-effective for the fund.
Okay.
But the point is, there are all these nuances to how these funds operate.
Yeah.
And understanding those nuances, I think, can really give you a better grasp of, their potential impact on the market.
It's crazy how something that sounds so simple, like just tracking an index, can be so complex.
Yeah, it really highlights how important it is to look beyond the surface, and understand how these things actually work.
So we've been talking a lot about the S&P indices, but what about the rest of the world?
Right.
Like, do those FTSE indices or the ones in, Japan or other countries?
Right.
Do those behave the same way?
Right. Yeah, that's where things get really interesting.
Okay.
So while, the basic principles of these index funds and the index effect, they're pretty universal. Research has shown that things like, the size of the market, how liquid it is, even like regulatory differences between countries, these can all have an impact.
So it's not like a one-size-fits-all.
No, not at all.
No. For instance, some studies, they found that the index effect might be weaker in less developed markets.
Okay.
Where trading volume is lower.
Yeah.
And, information might not flow as efficiently.
Okay.
On the flip side, you have these emerging markets, lots of growth potential.
Yeah.
They might see more dramatic price swings.
Interesting.
Around these index changes.
So each market kind of has its own, personality.
Yeah, I like that.
When it comes to this. Its own quirks.
It's like its own little ecosystem.
Exactly.
All right, so we've covered a lot.
We have.
We talked about the traditional view of the index effect, the surprising findings about demotions, the fact that the announcement date, it's super important, the impact of passive investing, even how this effect plays out differently around the world.
Around the world.
But before we wrap up, I want to go back to one of the biggest questions we raised.
All right.
Can savvy investors actually use this knowledge to their advantage? And if so, how?
That's the million-dollar question, isn't it?
It is.
And to be honest, there's no easy answer.
So stay tuned, folks, because we're about to get into the strategic side of this index effect and explore how you might be able to use this knowledge.
It's going to be good.
To make smarter investment decisions. All right, so we're back. And the big question is, can you, actually use this knowledge about the index effect to make smarter investment decisions?
Yeah, that's the holy grail, right?
Right.
I mean, the truth is there's no magic formula, but I think understanding the nuances can definitely give you an edge.
So it's less about predicting the future perfectly and more about just
tilting the odds.
Tilting the odds in your favor,
Exactly. For example, knowing that most of the price action happens on the announcement date might make you think twice about, chasing a stock after it's already been added to an index.
Right. So by the time it hits, the mainstream media, the Wall Street Journal.
Oh, exactly.
The smart money has already
they've already made their move. Yeah.
But that doesn't mean you should just ignore these index changes.
Right.
Completely.
No, not at all.
So what should people do?
Well, instead of just blindly following the hype, you can use these announcements as a starting point for deeper research.
So let's say a company gets added to the S&P 500.
Right.
That doesn't mean I should immediately buy it?
No, not necessarily.
But it means maybe I should look into it.
Exactly. Dig into their financials.
Okay.
See what their business model's all about.
Understand their business.
Yeah, understand their business and really see,
Okay.
Do their long-term prospects actually justify all this market enthusiasm?
Okay, that makes sense. And then on the flip side, like what if a company is getting kicked off an index? So same kind of approach.
Same idea. Instead of, freaking out, selling immediately.
Panic selling.
Yeah, panic selling. Take some time, assess the situation.
Okay.
Are the reasons for the removal kind of temporary?
Right.
Or are they a sign of, like, deeper problems?
Okay. So it's all about, like you said, looking beyond just the surface level stuff and making like informed decisions.
Informed decisions, yeah, based on your own analysis and your risk tolerance.
And then thinking back to like those different types of index funds.
Right, yeah.
Like remembering whether a fund does full replication or sampling.
Right.
That can actually help you. Right.
That can be really helpful. For instance, if you know a fund uses full replication, you can be pretty sure about how much buying pressure they're going to put on a newly added stock.
So it's almost like by understanding the index effect and how these different funds work, you can kind of like anticipate market movements a little bit.
You can get a little glimpse, like you're peeking into the playbook of some of these big players.
But we also have to like be realistic here.
Oh, of course, yeah.
This is the stock market.
Right.
It's unpredictable.
It is, yeah. I mean, there's always going to be those curveballs, those things you just can't foresee.
Okay, so the index effect, it's not like a crystal ball.
No.
But it helps you kind of...
It gives you context.
Yeah, understand like the bigger picture.
Exactly. It helps you frame your decisions.
Okay, it's like having a map.
Yeah.
But there's still like, parts of the map that are uncharted.
Exactly. There are still those blank spots.
Right. So for our listeners who are like really, want to take all this information, like what's the one thing, the one key takeaway you want them to remember?
Don't underestimate the power of information.
Okay.
The more you know about how the market works, the better decisions you're going to make.
Right.
Whether it's the index effect, company financials, global trends, knowledge, it's your most valuable asset.
So true. Well, on that note, I think we've reached the end of our deep dive into this pretty fascinating world of the index effect.
It's been fun.
It has been fun. Thanks for
likewise,
for joining us on this journey. And to all of you listening out there, remember, the market is always changing.
Always.
So keep learning, stay curious, and don't be afraid to, question everything you think you know.
That's right.
Who knows? Maybe you'll be the one to uncover the next big market anomaly. Until next time, happy investing.